So we're back and virtual. Is that
Virtual.
virtual?
Virtual.
Virtual coffee break for all of our coachable audience.
Yeah, very coachable.
Your retirement coach here. Today we're going to focus on the big, beautiful Bill. Not to be confused with J Bill.
No, he is beautiful.
That's
though.
another beautiful Bill.
That's another beautiful Bill.
There's a lot to unpack here. And there's some things, Nick, that you're going to help us get a better understanding of today, that it's like, how does this actually rubber hit the road, and how does it apply to me and my household?
Yeah, and there's just so much in this bill. Okay, so some people are calling it ABBA. By the way, all right, that's actually a thing that's circulating right now.
Yep.
But the one big beautiful bill. There's just so much content. So no one listening today is leaving an expert, okay?
Right.
I've poured hours and hours. And I know you've spent so much time in this thing. And today's hope is that we're going to educate our audience about some of the things that are happening within this bill that will affect, if you're a business owner, if you're a retiree, we're targeting more towards you. We aren't really delving deep into the health provisions of the act. This will be more tax-centric, okay?
Yeah.
But, I did think of another name for this One Big Beautiful Bill Act.
Hit me with it.
How about One Big Beautiful Mess Act?
There you go.
Because it's a mess.
It's
it
a mess.
really is. There's so much.
Well, if you're scratching your head about this bill, don't get upset. There's people in the District of Columbia that are like, I don't know how this is coming together. So it's okay.
I still don't think everyone's read it yet.
No, yeah.
So,
that too.
So anyway, for our audience, we do hope that you get a lot of value out of some of the breakdown of this bill that might be more applicable to you as a retiree or a small business owner. But let's kind of jump in.
Yeah.
And I'll say this, Aaron, before we've got some great slides we're going to run through for the audience so that they can take notes, etc. But I want to frame it like this. The One Big Beautiful Bill Act is essentially just a continuation of the Tax Cuts and Jobs Act. Okay.
Right.
And there's a few new nuances to it, etc. But for the people out there, come April next year, where are my big tax savings? What's the big difference here? I want to just encourage you. The big difference is that the Tax Cuts and Jobs Act didn't officially expire, and you didn't go back to the pre-Tax Cuts and Jobs Act provisions and tax rates, etc. Right. So you would have really experienced some tax pain. Many of our audience would have had we reverted back to pre-Tax Cuts and Jobs Act. But really, this one big, beautiful, all right, I'm going to start calling it ABBA, right?
It is easier.
But the big thing is that you're not going to experience as much tax pain had the Tax Cuts and Jobs Act expired.
Yeah.
This bill has something for almost everybody in it in terms of tax savings.
Yeah.
Almost everybody is going to find something that they're going to be able to apply and have some type of modest tax savings.
Yeah.
Very few people will find much bigger tax savings. And then, especially for our business owners, they're going to continue to enjoy some more privileged, very excellent tax savings through 199 deductions, et cetera, which we'll get to.
If you've got a more specific question, if this leads to ideas and you want to get something in front of our coaches, remember, you can always email us at connect@yourretirementcoach.com.
Yeah, no, great. We love your questions. We always try to get right back to you. But let's go ahead and jump in. Okay, so planning, understanding, and benefiting under ABBA. One Big Beautiful Bill Act, that is the official name of this act. It's not a joke. It's not satire. That's what it's called, and only under President Trump that we would get something called One Big Beautiful Bill Act.
Huge.
Yeah. We're going to jump in. So here's kind of a quick cheat sheet. I really like this. Who qualifies, okay? So we're going to talk about qualifications, phase outs, planning moves for especially retirees, families, and small businesses. And also, I want to point out that there are so many provisions here that are retroactive to the beginning of the year.
That is one of the biggest points that I think a lot of people, as we're sharing this, the breakdown, the message of this, the retroactive piece, people are shocked by. So hear that today. Like what we're talking about, it's not something we're looking forward to coming up next year. We're in the thick of it.
Yeah, no, and it's a great point. So it might not be a bad idea if you're thinking about your income and tax planning this year, get with your tax professionals now.
Yeah.
Don't wait till the end of the year. Don't wait till April.
Yeah.
Maybe you need to adjust down based on where you fall with some of these provisions,
Right.
your estimated tax payments. Right? We don't want to overpay Uncle Sam.
Right.
So you might need some adjustments within your payroll tax withholdings, et cetera. Get with your tax professional. Have the conversations today.
You just need a big, beautiful appointment.
One big, beautiful appointment. I think it's also important to understand, while we do have a lot of phase outs, somebody asked me recently, I keep hearing the word permanent, but it feels like nothing's permanent.
That's a good point, Nick.
These permanent tax changes or rate changes, right? So we're keeping the tax rates from the Tax Cuts and Jobs Act, and they've been made permanent.
Right.
Okay. Well, technically, let's think about this. Permanent really means that it's going to stay the same until the next Congress shows up.
Right.
And then they can, change it to something else. Like estate taxes have been banished. Like they've been voted away either 3 or 4 times permanently. There is a different definition in Washington, D.C. for the word permanent than for all of us, everywhere else in this world. Let's go ahead and keep moving, because I do think this is really important that we get through all this material. Basic standard deductions and rates. I love this. Basically, the standard deduction stayed a doubling plus. And what I mean by that is it is inflation indexed, so it will continue to increase every year. But if you are single, your standard deductions $15,750, head of household $23,625, married filing jointly $31,500. That's healthy.
It is.
Right? And so I think there are going to be many people, especially, and this will make more sense in a minute, in lower property tax states that will continue to go the route of the standard deduction than itemizing their deductions. So again, we talked about the Tax Cuts and Jobs Act, individual brackets, 10% to 37%. Those are all stayed the same, and they've been made permanent. Personal exemptions still repealed for most people, but there is this senior bonus temporary deduction, and we'll get to that because I love that. For most people, they're going to continue to avoid the AMT. Alternative minimum tax. I like to call it the mandatory maximum tax, but most people are going to continue to be able to avoid that.
Gotcha.
Now let's talk about the senior bonus deduction. So in our next slide here, I really like this. If you are 65 and older, you now get $6,000, not per couple, per eligible person. So if you are married filing jointly, and you're both 65 and older, you now get $12,000.
Yeah.
That's incredible. And what I love about that, Aaron, is that number, that $6,000, stacks on top of the standard deduction. That's unbelievable to me that this was like a really shocking gift that was given to a lot of our retirees, and I'm really excited about this because this opens up a lot of Roth conversion planning for our retired clients that might not be thinking about Roth conversion planning.
100%. Had clients this week where one of the spouses has turned 65 last year, the other spouse will turn 65 next year, and they said, "Oh, I've got a reason to keep you the next few years." So we need to add to those trusted professionals, counselors and therapists and those kind of things as well. But this is helping save marriages for at least a few years.
Especially those married filing jointly.
Mm-hmm.
Okay, here's the big asterisk.
Well, yeah.
Okay, here's the big but, if you will. If you are married filing separate, if you're both 65 and older, you do not qualify. Okay, so you will not. Neither of you will get the $6,000 this bonus senior bonus deduction. Now, there are phase outs. So if your modified adjusted gross income, if you're single, is $75,000 or above, there's a phase out for you. If you're married filing jointly and that income is $150,000 or above, again, there is a phase out as to how much benefit you can receive. And again, if you're married filing separate, I'm sorry, for whatever reason you are carved out. I would have thought that each spouse would have gotten $6,000 on their own tax return, but that's not what happened. They didn't ask you. They didn't ask me. They just did it.
That's right.
Okay. Last thing I want to point out here, Aaron, that this is permanent from 2025 to 2028, and you must have a work-eligible Social Security number as a taxpayer. So if you don't have that, again, you do not get this benefit. Now, let's talk about Social Security taxation. So big misunderstanding out there. I'm hearing this all over the interwebs, okay, that Social Security tax was banished or Social Security tax is still here. There's all these questions around Social Security taxation. We're going to keep this high level without getting into the weeds. But basically, ABBA, did not rewrite Social Security taxation formula, and it's still based on provisional income thresholds. So what are those thresholds? So you can Google this. You can go to socialsecurity.gov or
SSA,
right?
yep.
ss.gov. And you can check this out for yourself. There's a calculator there that you can play with. But the thresholds are $25,000 of provisional income if you're single, $32,000 married filing jointly. The thing that confused a lot of people, Aaron, is there's a lot of thought that if it was $25,000 if you're single, it'd be $50,000 married filing jointly. It is not, and a lot of people have fallen into that trap thinking they had a benefit that they didn't. So married filing jointly, provisional income, and again, that calculator, you can find it. You can Google it. You can go to ss.gov, and it is $32,000 married filing jointly. Now, to get really the big deductions available through Social Security to reduce taxation on Social Security, timing and sequencing are our friends.
Yes.
Okay. So loading up in years where we want to maybe do significant charitable planning, we call that bunching deductions in 1 year for multiple years of benefits, or in just one really great year to do things like Roth conversions or to reduce the taxation on Social Security. You need a plan in place to do that. It can't be haphazard. It has to be extremely intentional. You need to get your financial professional and your CPA talking together to try to help you maximize the tax savings on your Social Security. All right. This has been talked about a lot, and I got to tell you, I had a talk recently with this gentleman. He's retired. He's working on a golf course. He's a runner. He's both taking, your tee times in, but he's also running the golf carts and, that kind of thing. And he's tipped, okay?
Sure.
He loves his tips because it pays for his cart fees at other courses. He plays free there, but it allows him to have some fun money, right?
Sure.
And so he said, no taxes on tips, eh? And so here's the thing. If you are a moderate earner, so you work in hospitality industry, restaurant industry, etc., let me tell you, this absolutely could be a benefit to you. Now, is this saving you tens or hundreds of thousands of dollars in tax? No, but I don't care if I save $50 in taxes, Aaron.
Yes.
$50 is $50,
Yes.
right? And the reality is there are a lot of professionals in the hospitality and restaurant industry, golf courses, etc. You receive tips. And the nice thing here is it's not no taxes on tips. A lot of people are confusing this.
Right.
It is actually a deduction. It's an above the line for our people that file your own taxes, etc. It's an above the line deduction. Now, here are a few things. You could deduct up to $25,000 of qualified tips, and this only applies to your federal taxes. Okay, there is a phase out which starts at $150,000 single, $300,000 married filing jointly according to your modified adjusted gross income. Full phase out is $400,000 single or $550,000 of income married filing jointly. Now, some people, like when I've shared this, they've asked, well, that seems like really high. Do people who receive tips really have that kind of income? Well, you have to think you could have two earning spouses and one could have a much higher earning job. One could work more on tips. That could be the thing. But Aaron, I got to tell you about the best steakhouse. Well, top 3 steakhouses I've ever been to.
Hit me.
Okay. There's a place in Tampa, Florida called Burns.
Okay.
Okay. And, you talk about wow factor. It's not the looks of the building because you're passing warehouses and all kinds of stuff.
Gotcha.
All right. But you roll up to one of the preeminent steakhouses, especially in Florida. But I mean, it's one of the best I've ever had. I mean, it's great. Okay.
Sure.
You walk in, it's got a wine cellar. It's one of the it might be the largest private collection of wine in the Western Hemisphere.
Oh my goodness.
It's huge. And they give you a tour after dinner, and man, I did not want to fall. I'm a bull in a china shop. I was about to break a 1900 wine from wherever. But a lot of their waiters and waitresses there are so seasoned. They make easily 6 figures.
Sure.
Okay, and they've been there 20 plus years. So many of them.
Yeah.
They are professionals. They are amazing at what they do.
And you're going to tip them accordingly.
You are going to tip them accordingly, and they make. And so there's a lot of that the general public might not understand is out there, that this is really helping them.
Yeah.
Eligibility. So here's the deal. You really do have to report your tips and provide work-eligible Social Security number. You must file jointly if you're married. This all comes back to married filing jointly. I don't know why, again, exactly they did this, but there's a lot of exclusion if you're married filing separately. Be careful. This is a trap for some people.
Yeah.
Seek wise counsel. The employer's angle, it expands the employer credit for tips on payroll taxes. So that is not industry, wide. There are very specific industries where that does apply. Again, if you're a business owner and this applies to you, talk to your CPA. Now let's go to the SALT deduction. Aaron, of everything that actually passed and that was reconciled between Congress's bill and the Senate's bill, which the Senate came back twice to reconcile this thing. Yeah. The thing that it was so highly contested, it was argued on, people are on pedestals yelling about this thing, was the SALT cap.
Yeah.
So for our audience, SALT stands for state and local taxes. This is a deduction that you were capped at $10,000 under the Tax Cuts and Jobs Act.
Yeah.
So if you're in a higher tax state like California, New York, New Jersey, oh my gosh, you are getting crushed because you were capped at $10,000 that you could deduct with these state and local taxes.
It's more irritable in those locations. Some might say it could leave you salty. Anyway, I'm sorry, Nick. Go ahead. No, sorry.
I'm glad to have you, Aaron. All right.
I'm glad to be here.
Anyway, here. So it was shocking to me that we actually got this in the final bill. They adjusted it to $40,000 as the largest deduction you're going to be able to take state and local taxes. Mm-hmm. Now, there is an income test. You got to pay attention to this. It's a 30% phase down. We hear about phase ups and phase outs. This is a phase down on above $500,000 of modified adjusted gross income. It is indexed starting in 2025. But what this essentially means is $500,000 and above, as your income grows, what you can take as this SALT deduction starts going down, and it bottoms out at $10,000. So even our ultra high income earners are still going to get that $10,000, right? So itemizers, high tax states. One of the things really I think about, if you are charitably inclined.
Oh.
You give to your church, you give to the local theater, American Heart Association, whatever, is your thing, St. Jude's. You care about these organizations. Timing of your charitable gifts are really, really important to maximize the SALT deduction as well as your charitable. You get to combine those, then it can become easily a better thing than the standard deduction. Because what ends up happening, Aaron, is, $500,000, you look at the standard deduction, you might be right on the cusp of, whether you should do standard or you should itemize. Well, this additional $40,000 on SALT above the former $10,000 means I think a lot more mid to high income earners in these high tax states should look at bunching their deductions charitably to get an even better deduction.
Yeah.
So don't overlook that. Now, we were just talking about charitable giving. This is kind of just a gimme, to be quite honest with you. Kind of creates a 2-year cycle of where you might want to give really, 1 year, maybe kind of a skip a year thing. So you kind of plan around having one big year that you pair with the SALT deduction. And so for non-itemizer deductors, taxpayers, I think I made up a word.
Listen, we're just going to roll with it. It's called coining a phrase, Nick. And if anybody else says deductors, we're going to say, you heard it first.
You know what? I want a t-shirt, Aaron. I just want a t-shirt.
Coachable.
All right.
Let's go.
Stay coachable, baby. All right. So this excludes donor advised funds, supporting organizations, and private foundations. So here's the deal. You get $1,000 if you're single, $2,000 married filing jointly. So if you're a non-itemizer, you're doing the standard, you're going to get that on top, even if you don't do a full itemization or bunching, okay? Yeah. The floor is, so this is what you have to exceed. 0.05, so 0.5% of your adjusted gross income floor, and it's only amounts above that. Now, this is unique. This starts in 2026 and beyond. This is not retroactive.
Correct.
Okay. So we want to plan on, and we put bundling gifts, bunching gifts, using appreciated assets, QCDs from IRAs, etc.
All the more reason why this year might be a great year for bunching. Take advantage of this next year.
100%. You said it perfect. Child tax credits, so 2025 and beyond, so again, retroactive, $2,000 per qualifying child in 2025. It is indexed, so that number will continue to increase from 2026 and beyond. The phase-outs for income, $200,000 if you're single, $400,000 married filing jointly. And then, of course, they really, really threw in here, and there's so much, posturing and positioning politically today around immigration. We're not touching that. I just had this belief that perhaps we're seeing so much around Social Security number, work eligible Social Security numbers, because our government's trying to make a point. You have to have that in order to qualify. And that's all I'm going to say about that.
And I'm not going to touch it.
Yeah, don't touch it. Don't touch it.
Yeah.
529 plans and education updates. Huge. This is huge or huge. So 529 plans have gotten some radical benefits, between a couple of years ago and this year. The expansion, from Secure Act and being able to convert over time to, unused 529 plans, to Roth IRAs for your kids or others, to the expansion from beyond trade school and college to being able to use it for private school or, K through 12 education expenses, or even summer camps. Mm-hmm. It's pretty amazing at what these, and Aaron, I've got to tell you, and if you're listening or watching today, you really should pay attention. If you kind of ruled out 529 plans as a part of your strategy or plans, circle back around with your financial planner, your financial advisor, your tax guru, and revisit this. It might make sense to really take a look at 529 plans again because they have expanded what they offer so much.
Yeah.
Now, K through 12 expenses, if it's a qualified educational expense, the annual limit that you can use is now $20,000 out of that 529 plan, which is amazing. I know some kids who are going to an alternative school because of some, they're dealing with some special needs.
Mm-hmm.
Expensive. Not in not really any scholarships available. There is some different private funding, etc. But really, the parents are
Not to
paying
the
out of
level.
pocket
Yes.
radically. I was talking to them. The grandparents have been setting aside before they knew there were going to be these special needs. They were thinking college. They're now able to use it for these educational facilities, these institutions that are providing an incredible value, and they're able to pay for it out of the 529s, which is awesome.
Mm-hmm.
Okay, post-secondary and credentials. Now, it is funny. There are everything from golf schools to culinary art schools. There are so many different educational institutions that do qualify to be able to use these 529 funds. And Aaron, two of my favorite words: tax-free.
Yes.
Okay, and I love tax-free. So employer education benefit, now up to $5,250 of tax-free assistance is made permanent and inflation indexed after 2026. So employers actually can assist in these plans, and there is a benefit for them. Again, you just have to explore those rules with your CPA. So the state of Georgia, other states, you need to really look at what additional benefits you might get from state tax deductions, but because it is so state specific, but explore what your state offers. Here in the state of Georgia, we do have a state tax deduction for contributions to 529 plans, and sometimes that's overlooked.
Because many of those are very similar in nature. So why not be a part of what's state specific for you so you're not forfeiting any added benefits?
Yeah, I mean, there's very few 529s that offer some kind of radical advantage to using another state's plan. There are some that are more expensive. There are some that have more investment options. But at the end of the day, the purposes of education of what you're trying to do, it might not matter as much as you think. Small business owners. So here's a little highlight. 199A deductions are made permanent. Again, until the next congressional session. Limitations phase in, not phase out or phase down. Phase in ranges have increased $75,000 if you're single, $150,000 married filing jointly. There is a $400 minimum deduction for modest QBIs, but at the end of the day, pay attention to that. It's great that that was made permanent. Now, the one that I see a lot of business owners getting excited about, Aaron, is full expensing. It's back. If you're a business owner, it's back. It's permanent. 100% bonus depreciation. So this is made for all qualified property purchases that are placed in service retroactive. I don't know why we didn't go to January 1st, but January 19th, 2025, it goes retroactive to that date. So if you have made some purchase, so vehicles, equipment, etc., get with your CPA, revisit what your actual tax savings is, because we're now dealing with 100% bonus depreciation. You have to revisit this. Okay. Now, for a lot of people, and Aaron, I'll say myself included, there's been a little workaround with getting a little bit better than $10,000 on the Tax Cuts and Jobs Act SALT cap. Okay, state and local taxes cap has been $10,000, going back to 2017. Well, and yes, it's $40,000 now going forward, but here's the deal. You could use something called a PTE tax election, and you could factor that in through your business to help get a little better state tax deduction using the state and local taxes. You really want to look at this because it's still in play, And you should try to coordinate this. So talk to your tax professional about being able to use that. Estate and gift taxes. Now, again, this is from 2026 going forward. Well, with one exception here. But so estates with $15 million individually or $30 million married, filing jointly, and indexed. If you're under those income thresholds, you don't have to worry about federal estate taxes. Now, depending on where you're located, you might have a state estate tax. You need to talk with your professionals on that one. But at the end of the day, these are some really, really high numbers. If the Tax Cuts and Jobs Act had expired, there were so many people that were looking at this number landing between 3 and 5 million. Some people thought up to 10 million, but the general consensus was somewhere around 5 million. So this does extend it. 15 million as an individual filer, married filing jointly, $30 million. And so if you look at your situation today, don't get excited because these numbers are really high right now and you don't have to worry about it. No, now is the time you do planning.
Right.
There are unique tax and trust structures, things you can take advantage of today because of where these exemptions are, that when the exemptions go lower, you're going to be really, really upset and it'll be too late.
Yeah.
So you really want to have the tax and estate plan today because, maybe you are a married filing jointly filer and your estate's in the $10 million range or the $12 million range. If that continues to grow or even stays the same and we go back to $5 million in the future, oops, you missed your window.
Yeah.
So look for the opportunities to plan today. And if you're an individual income earner and maybe you're a little higher wage, again, same thing. Plan today for what could be much higher rates in the future. And Aaron, I know I've got bias as you do. I absolutely think that tax rates will be higher in the future. When? I don't know.
Right.
I just know the word permanent doesn't mean much in Washington.
Right.
So we've got a deficit that is out of control. Right? Our government does one thing really, really well. Republicans and Democrats, I'm an equal opportunity offender. They both know how to spend money.
That's absolutely true across the board.
Right?
Yeah.
And so we've got to do something, Aaron, to curb that. Now, I'm not in favor of higher taxes, but I think they are going to go that direction. I think they should stop freaking spending money. That's a technical term.
That's
Okay.
No.
All right.
But from that, guys, make sure you're working with the trusted professionals. Go through your projections. Find out if you are in the crosshairs and need to do the advanced planning for this, and then work with your estate planning professional to make sure you've got the appropriate instruments in place.
Yeah, 100%. Now, from a planning perspective, you really do want to look at refreshing your plan for 2025 moving forward. While this exemption, it does go to, really starts in 2026, the numbers are still high today. Start planning today, forward looking. Consider spousal portability. It used to be if you didn't use it, you losed it. All right. So you would use your estate exemption by filing under a credit, shelter, trust, etc. when the first spouse passed to capture your exemption.
Yes.
Well, then entered portability. And what would happen is with a gift tax or estate tax return, what you would do, or the final tax return, you would elect a spousal portability where you would take their unused portion of their exemption amount and you port it over to yours, so you would increase your exemption amount. If you don't do that, you lose it. So you want to take advantage of that. And I'm sorry, again, if somebody has lost their loved one here this year, we certainly are not trying to be, coarse or anything like that. We are simply pointing out we want you to pay legally less taxes. And one thing to not overlook is whether or not you did elect portability. So talk with your CPA or your financial professional and see if it's too late, if you can amend or adjust, or maybe they did elect on your behalf.
And Nick, that's such a good point. And we never want to come off insensitive, but sometimes really caring about somebody means having the hard conversations.
100. Thank you, Aaron. Yes. So we want to revisit our gifting strategies, Dynasty Trust, and again, make sure you're paying attention to state. You like the word dynastic?
Yes.
Oh, it's official. Dynastic. Also going on a T-shirt. All right. Here's a quick eligibility matrix. So let's break down what we've learned, okay? So senior bonus deductions, 65 and older. Again, if you are 66 and your spouse is 59, you get one senior tax deduction or bonus deduction, and that's $6,000 stacked on top of your standard deduction. Okay, phase outs, $75,000 single or $150,000 married filing jointly, according to your modified adjusted gross income. And again, I'm sorry, to our married filing separate filers, you do not qualify. Okay, no taxes on tips. Well, technically there is this tip, tax deduction. Pay attention to those numbers. I think a lot of people in the United States are going to qualify. For most people, it's not going to be a huge deduction, Aaron.
Yeah.
It's not going to be a huge break.
Yeah.
But again, if you save $50 in taxes, you save $50 in tax, whatever it is. If it's, and by the way, I did a small calculation on this.
Yeah.
And I just used some very, very, light numbers. But it'd be very easy for somebody to save $1,000 to $2,000, like very easy part-time $1,000 to $2,000 easily in taxes with this deduction.
We love all of that. We had a CPA come back with us last week about a plan we were working on. They said, this is only going to save you about $800 to $1,500 with this part of your plan. And we were like, great.
Yeah. Like it was no big deal.
Yeah. No, we're like, any of this is thrilling and it all adds up.
Oh, it is. And it's your money.
And it's your money.
I don't want to overpay the government $800.
Correct.
Right?
Correct.
So SALT caps, again, $40,000 cap if itemizing. It doesn't phase out. It doesn't phase up. There's no phase in. It phases down. So if you're $500,000 or greater in income, modified adjusted gross income, again, it does start going down in terms of what you can take as the SALT cap deduction. Now, Aaron, I do want to point one more thing out that this was interesting.
Mm-hmm.
So as everything else we talked about, individual income and married filing jointly income.
Yep.
This is almost like a marriage penalty in how they've done this, because you would have thought that maybe if you're married filing jointly, there'd be an $80,000 SALT deduction, or there would be a $60,000, an increase above the $40,000. They didn't do that. I don't know why, but if you're a single filer or married filing jointly, it's $40,000.
Yep.
There is no increase.
Yep.
All right.
And not permanent.
And not permanent. All right. So again, looking at this from an eligibility, charitable non-itemizers, there is that benefit of $1,000 to $2,000. It excludes donor advised funds, supporting organizations, private foundations. But again, if you're not itemizing and you want a little sweet cherry on top, there's that 0.5% threshold, but it is something, right? So it is encouraging us to continue to be generous. We've got the child tax credit still at $2,200 with phase outs. 529 plans, again, it expanded from $10,000 to $20,000 as to what you could do through that K through 12 education. And don't overlook things like the summer camps, etc. However, here's my little warning, okay? My little asterisk. Mm-hmm. If you can cash flow it and you can pay for those camps and you can pay for, the private school education, let the 529 plans continue to build up.
Yeah.
Grow, baby, grow.
Yes.
Because it's growing tax deferred, and in the future, you could use it tax-free, or you could convert it over time. Again, there's rules around this, but to a Roth.
Yes.
So, again, if you can, let it cook, let it sizzle, let it grow. All right. Estate and gift tax, again, thresholds have increased, 15 million single, 30 million married filing jointly, but this is indexed starting in 2026 to continue to grow. How about a planning playbook, Aaron?
Every coach likes a playbook, Nick.
I like a playbook. All right, quick rundown here. We want to sequence our income to try to keep our Social Security as untaxed as possible. You can do planning. Not everyone's going to be able to do this. I realize that, but I do want you to at least talk to your financial and tax professionals to see if you can alleviate any taxes on your Social Security. Is it fantastic? Is it the best ever? Is it huge? No. But if you could save a few $1,000s on your Social Security, why not, right? So do some planning there. With the senior bonus deduction years, take this time where you're getting this additional $6,000 to $12,000. Take the additional time to plan out some strategic Roth conversions. These can be mini conversions, or these could be more grandiose if you are doing things like, itemizing, etc. But have a plan in place. Everything counts. And, Einstein says, one of the wonders of the world was compound interest. Compounding these Roth conversions over time adds up very quickly. Don't overlook this, especially if you're retired. There is this misnomer that, once you hit 65 or once you retire, that things like Roth IRAs go out of play. Nothing could be further from the truth. Over the last 100 years, one of the biggest gifts that we've been given is 30 extra years of life expectancy. If we're living longer and longer and longer, and these tax rates are low today with a growing deficit, tax rates are probably going to be higher at some point in time in your life. Don't overlook things like Roth conversions. Itemize opportunistically around the SALT cap window, okay? Bunch our deductions in those years where it might help us get that above standard deduction, so where itemizing makes sense. Aaron, as you said, every couple years, we could do a much bigger bunching of a charitable deduction that might give us, pay those organizations we care about for years forward looking. If we marry that with a SALT deduction, over the next few years, you could save a lot of money.
100%.
Okay. If you're a tipped worker, I can't emphasize this enough, maintain excellent records, okay? You really want to. Now, many employers give you access to systems to record your tips. Don't be scared to do that today. Many people are like, man, I don't want to report everything. I really need the income, etc. And, I'm not going to go too much further there.
We don't
Black,
operate in the
white,
gray.
I'm not going to play in that area. Maintain your records. You have this period of time to really benefit and avoid taxation on your tips. For our business owners, optimize your QBI. And again, because it is retroactive to, January, look back at that full bonus depreciation. Don't overlook that. That is going to save a lot of business owners a lot of money.
Yeah. So, Nick, football season starts, and my son's got his first game tonight. They practice the plays, but then they watch tape. What are they looking out for? So we went through the playbook. What are the things that we need to be looking out for? What are those gotchas? What are, because I feel like that's just as important.
No, and I'm really excited. Shout out to Mr. Payton.
Yeah.
But here's the deal. You are so right. Sometimes there's a hole in the game plan. Sometimes you got this great plan, but the other team, they already know your moves. They already know your plan.
Mm-hmm.
They know your formation, and they're going to be able to, their defense is just going to rule you, or their offense is going to run you down the field.
Or we're looking for their gotchas.
We're looking
and
for
where we can maximize.
That's right. So, winners win at the end of the day. Here's the disqualifications and gotchas that we got to play around. Again, I've said this a few times, married filing separately. Again, a lot of people are going to think that they're going to get a certain benefit that you're not going to qualify for. So meet with your tax professionals to see what might be able to be done. And maybe there is a reconsideration of married filing jointly. Everyone has their own reasons from asset protection to trial separations. There's so many different reasons that people do married filing separately. However, maybe it is a good idea to revisit married filing jointly. You should never do something purely based on taxes, but also don't overlook taxes. Okay, social security number requirements. So many of these provisions in ABA, okay, they do require an official worker's social security number. It's got worker eligible social security number, and so just be aware of that. Charity rules, non-itemizer, above the line deductions excludes donor advised funds, which Aaron, we're huge fans of. Doesn't mean you shouldn't do one. Just be aware there are some maybe small tax savings you might not qualify for with giving to a donor advised fund. State conformity. Not all states conform to the SALT 529 deductions. Verify with your state. We're here in Georgia, and so you definitely want people to understand. Yeah. We have clients in just shy of 20 states. There are so many nuanced rules out there.
Yeah,
you got to pay attention.
Yeah.
Sunsets. The senior bonus deduction, the tip and overtime deductions, they end after 2028 unless there's a new law that continues it, kind of like the Tax Cuts and Jobs Act was set to expire at the end of this year. But now looks like we're going to be able to continue so many of those lucrative benefits. Before we move on, again, my encouragement to you, one of the rarest things that we see professionally, and I speak at lots of local organizations. I'm an instructor at Kennesaw State University. We teach, speak, and talk to people from all over the United States. And still the rarest thing I see, especially middle America today, is people that have a tax plan. If you don't have a tax plan, this isn't tax filing. Okay, tax filing is important. You have to do that. We're talking about tax planning. Having that 3 to 5 year plan as to what your target is to reduce your income taxes, your capital gains taxes, having tax-free income. Have a plan that you are very intentionally over your lifetime going to pay the least amount of taxes. This is important. So, we could talk all the time about how to have the shinier whistle because you've got a better portfolio than the next guy, or this portfolio is going to do amazing and outgrow or have less risk, etc. Those are important and good things. But the easiest and safest way we think to increase the return on your money is to legally pay less tax. Hopefully you're finding value in this. We're going to continue our best to keep you informed. Continue to tune in. With that said, we do appreciate you. Okay. If you know somebody who could really value from this type of content or would like an invitation to our classes or upcoming events, email us, connect@yourretirementcoach.com. We'd love to invite them. We want an educated community around us because then everybody has the opportunity to win. If you're not already subscribed, please check out our podcast. We have our YouTube channel, podcast on all the major streaming services. And I tell you, we're having a blast, but it's one of the easiest and fastest ways we can keep you informed. It's released every other week, and everything from Roth IRA mistakes to avoid, 401k optimization, estate planning, to most recently, how to buy a car.
There you go.
Right? So we do want you to stay educated, stay informed. This is a really great way to do it. We had the privilege earlier this year to be featured Cobb in Focus. We recently won Best in Cobb. And it's because of you. Many of you are our clients. Many of you in our community, our friends, colleagues, you voted for us. It's not lost on us that we have a business, we have a practice here because of the support that we receive from you. So just wanted to say thank you.
Absolutely.
And now the fun stuff, the fine print. Okay, got to have fine print. So 5, 4, 3, 2, 1. Next slide. And again, thank you from all of us. Last slide is just some sources and references. If you want to do some of your own digging and research, we really appreciate so many of these organizations and people that did give us access to this content. With that said, that's kind of the end of the slides.
Yeah.
But Aaron, any takeaways on your end?
Listen, I can't be the only one that every time we mentioned Abba, not to be confused with Abba, like Mamma Mia, kept singing in my head as we go through. So I'm wondering how many people are going to make their way over to iTunes or Spotify immediately after this.
We took a couple of our daughters and their friends to the Abba over at I think it was the Fox.
Yeah.
Great show. And it's all, forgive me, I didn't know it was all ABBA music.
There you go.
Yeah.
So hopefully this will encourage people to spruce up the playbook and their musical endeavors.
Vernacular. Yeah.
Vernacular.
Thanks for tuning in. Aaron, thanks for hosting today.
Wow.
Hopefully our audience got a lot of value out of today, but we certainly appreciate a coachable audience.
Absolutely. And in that, stay coachable.